Yo guys, what's up? I'm gonna show you now my strategy that's making me very profitable on the last few days. It's working pretty well. Let's go straight to the point. It's a silver bullet model. It's very simple and very straightforward to be honest. These are a few steps of a strategy. 1, 2, 3, 4, 5, 6. Very few steps. Just follow the steps and you'll be profitable. Let me show you here. First step, you go on 9:30 a.m. Eastern Standard Time. Just do a market preparation. Just look at the chart and see what's the current price right now and see the ranges of the Asian range and the London range. Simple. When you go to the charts at 9:30 a.m., then you look at the ranges of the Asian range and the London range, especially on 8 p.m. and midnight. And the London range, you go from 2 to 5. Very simple. As I said, Asian range 8 to midnight and London range 2 to 5 a.m. Cool. So after you mark the ranges, you mark the highs and lows. After this, you see if there's a liquidity sweep of one of these ranges. So the better the liquidity sweep, the most confident you'll be trading this strategy. Basically, if both of these ranges are taken, even the high or the low, you go to the last one or the strongest one. So look for the strongest one. I think it's a better approach to the strategy. I prefer not to trade when this happens in equal highs and lows taken. Look for one region, even on the day. Let me explain better to you. So on the day, if the high was taken, just do a sell. If the low was taken, just do a buy. If both was taken, you need to look if it's approachable, if it's a valid trade. You need to look if one of these ranges are taken, either the Asian session or the London session. It's a better option, so you can be more confident if you see that both of the ranges are taken. It's very simple, and I'm gonna show you where you're gonna to take a buy and where you're gonna to take a sell. Let's go. So has any of these ranges, either Asian session or London session, just ignore this 9 a.m. candle for now, okay? I think it's a simple idea just to go straight to the Asian and London session, okay? At this time here, as I said, okay? Mark the highs and lows for the Asian range, mark the highs and lows for the London range, and see if any of these ranges were taken. If no, don't trade. If yes, just continue to the next step. All of these on the 5-minute time frame. Wait for a 5-minute fair value gap, okay, to form. Let me be clear here. When the liquidity was taken of these sessions, right after 10 a.m., you look for a fair value gap. All of these, you look on the 5-minute time frame. So you're not gonna change the time frame. You're only going to use the 5-minute time frame for this strategy. You don't need to look for other time frames. Right after 10 a.m., you look for either a bullish or bearish fair value gap from 10 a.m. to 11 a.m. You can do from 2 p.m. to 3 p.m., but I prefer to 10 a.m. to 11 a.m. And so let me show you here with my hands. If you have like Asian session and the liquidity was taken on the highs, you look for a sell. If the liquidity was taken on the lows, you look for a buy. As times goes on, you're gonna get used to this strategy. That's what I'm going to say. Confirm the direction of the range break. If the fair value gap is bearish, if the fair value gap is a red one, it's going to the downside, the range high must be taken. And if the fair value gap is bullish, the range low must have been taken. Cool. If the conditions are met, you execute the trade in a 2-to-1 risk reward ratio. Just enter a limit order at the fair value gap, the stop loss behind the candle 1 of the fair value gap, and target 2R, 2 risk reward ratio, or close the trade by the end of the day. It's closed by the end of the day on the futures market, you close the trade. Okay, let me show you some examples here. Here's the Asian session. Here's the London session. Here is the range, and here is the London range. We see that the Asian session, the high was taken, and the London session, the high was also taken. So if the high was taken, we're gonna take, you're right, we're gonna take a sell. It's 10 a.m. here, and we wait for the first fair value gap that is bearish. It's 10 a.m. This is the first fair value gap. This is a screenshot, by the way, bear with me. The first candle, the second candle, and the third candle of the fair value gap. This is the fair value gap, is the gap between 3 candles. And it's first, you can search for fair value gap, but it's very simple. You can also use some indicators, fair value gap indicators on TradingView. The first candle, the second candle, and the third candle of the bearish fair value gap. We are gonna enter the trade after the fair value gap is formed. It's gonna be formed after this third candle. After it's formed, we're gonna put a limit order right after, right on the fair value gap here, and the stop loss will be above the first candle of the fair value gap. Cool, that's a win. So do a back test with this strategy. It's working pretty well with me. So guys, here's another strategy. We can see that we didn't get a win here because it was closed by the end of the day. This is a third strategy. We can see here that it was closed by the end of the day, but it's not a problem. This strategy is very simple, and I kind of like the strategy because it's, even though it's a 5-minute strategy, it's a pretty slow strategy, but in a good way. So you just have 1 hour to trade this strategy, and when you enter the trade on a fair value gap, you just wait to hit 2-to-1 risk reward ratio. Or if you see that the trade is going like it's very choppy and not going anywhere, just close the trade and wait for the next day. This is like a 1 trade per day. Okay, guys, this is the next example here. The Asian session, the London session. Here are the ranges. Here are the ranges for the London session, and we had a liquidity sweep on the lows. That's the strongest liquidity sweep on the lows. Cool, guys. If we have a liquidity sweep on the lows, we're gonna take a buy. Cool. Taking a buy on the fair value gap here. We have the first candle here, the second candle here, and the third candle here. This is a fair value gap. This is a bullish fair value gap because it's going on the upside, and we enter the trade. We put the stop loss below the first candle of the fair value gap and target a 2-to-1 risk reward ratio. Cool, guys. So that's a very simple strategy. Let me know what you think about this one, because I'm having pretty good results with this strategy, and I think you have to just do a back test and put in the comments if you had good results with this strategy. Have a good day.